how the markets are shaping up as we get ready for today's trading session. Let's bring in Edward Campbell, Managing Director and Senior Portfolio Manager at QMA, and in Boston, Michael Tyler, Chief Investment Officer at Eastern Bank Wealth Management. Gentlemen, good morning to you both. Ed, I'll start off with you. You still think that we should be maintained at an overweight in terms of our equity allocations in our portfolios? Why?
Yeah, I think so. And, you know, we had pulled back from a more...
Is it a harder and harder case to make as the days go by?
No, I think, you know, this is... We've been we've had our first correction in a long period of time. And, you know, the average correction during this bull market has been 14%. We had a 10% correction. It typically takes a while to shake those off. So while I think we're still going to be in a period of churn, and we may have a summer of discontent, this is not the end of the bull market. It's an interruption, and I do think that when we get into the fall, we're going to move decisively higher again. So I think we wind up having a pretty decent year in equities.
Michael, you say that stocks can recover to new highs if the inflation data remains relatively calm. Does that imply that you need a Fed basically to remain on the sidelines, or at least go according to plan in terms of rate hikes?
I think that's what's going to happen. You know, we'll see the CPI number tomorrow and the producer prices this morning. But I think we're going to see there's not that much pressure on inflation right now, and I don't anticipate that there will be. One of the keys is oil, which we were discussing earlier this morning. I think that as the oil price has risen, U.S. Production has begun to rise as well. The Saudis have said they want $80 oil. I don't think that that's really within their control at this point. They don't have enough of the global capacity to control that. So as the U.S. production picks up a little bit, I think that does relieve some of the pressure. That does keep inflation in check. You look at the long-term bond yields, they're telling us they're stuck at 3. We're not looking at a lot of serious inflation, and I think that that does give the U.S. markets a chance to rise higher. It also means that the Fed is likely to exercise restraint.
You know, inflation at the headline level remains tame, but Ed, I'm just curious, is there a point where you get sort of concerned about the U.S. consumer facing rising gas prices, rising oil prices, as well as rising short-term borrowing costs? I mean, we're looking at a 2-year yield, which is now 2.5%. So not only does that cause short-term borrowings, home equity, lines of credit, et cetera, to go higher, but also provide some competition for stocks.
Yeah, I mean, you mentioned some headwinds for the consumer, but we've also got you know, pretty strong labor market. We've got the unemployment rate down to 3.9. We've got the benefit of...
With little wage growth, though.
Wage growth is you know, it's moving higher, but you know, as we saw in the latest number from the payroll report, it's still pretty contained. So one thing I didn't mention in support of the equity markets in your first question is booming earnings growth, right? So you know, we're through most of the reporting season right now, and year-over-year earnings growth is likely to come in at about 26%. So that's something that's supporting the market as well.
Michael, just quickly, not concerned about the consumer at this point?
No, I think the consumer is fine. You know, first of all, the wage growth is only 2.5 or so. But total compensation is higher because of non-wage compensation like bonuses and commissions and the like, which is increasing across a wider and wider group of Americans.
Right.
That's helping. So I think the consumer is doing just fine.
Okay.
Another thing in support of the consumer, you know, that we've seen in the post-crisis environment is the improvement in consumer balance sheets.
Right.
So the financial obligations ratio is very low. While we've seen corporations taking on debt, the consumer's been rebuilding their balance sheet.
Ed and Michael, our thanks to you.
You bet.
Coming up, Squawk viewers know Steve Joyce is the CEO of Choice Hotels.